If you've ever experienced losses in the stock market from chasing trends, or watched yourself miss a major profit opportunity in a clear uptrend, you're not alone. In fact, 90% of investors get left behind midway through a trend, unable to capture the most profitable moments like professional traders do. The underlying reason is not a lack of capital or information, but rather a misconception. Many people believe they can grab profits right at the beginning of a trend, but they are often left behind by the market for jumping in too early. Today, we will dive into how to break through this dilemma, uncover the core reasons why investors always get left behind midway in trends, and share with you practical strategies to help you capture key positions. New York, 1907. Panic spread like a plague, and the stock market trembled on the edge of collapse. The trading floor was filled with desperate screams and the sound of paper being torn. Amidst this chaos, one figure remained almost eerily calm: Jesse Livermore. He wasn't fleeing from disaster. Instead, like a patient leopard, his eyes pierced through layers of panic, fixed firmly on the price list for the Union Pacific Railway. While everyone else was selling recklessly at any cost, he quietly picked up the trampled shares. This was not reckless gambling, but a precise, calculated strike. The market eventually validated his judgment. After panic reached its peak, it was followed by a violent rebound, and Livermore expertly captured that fleeting key point, making millions of dollars in profit, equivalent to hundreds of millions today. The core mystery of this story is the ultimate question we aim to solve today. Why do the vast majority of people, even when they see the trend correctly, always get left behind halfway? The answer lies in Livermore's century-spanning wisdom, which, after being tempered by the market, has become sharper and more deadly. Trend identification and recognizing the birth of trends require far more patience and discipline than you might imagine. Livermore never chased the already running train. Instead, he spent his energy waiting for the precise moment when the trend would be confirmed, the critical point, when the supply-demand relationship in the market fundamentally reverses. As Livermore mentioned in Reminiscences of a Stock Operator, market trends are the foundation of all my trades. He didn't directly predict where a particular stock would rise or fall, but instead, he analyzed trends continuously to find the right entry and exit points. This concept still carries profound guiding significance for today's investors. You must learn to identify and judge trends in the market, not just by short-term fluctuations but with a long-term perspective. Many people mistakenly believe that following market fluctuations will lead to profits, but the reality is that entering at the early stages of a trend is the only way to maximize profits. You can use technical indicators to help confirm the direction of a trend, but these indicators alone are not the absolute deciding factor. What's more important is to learn the market's emotions and the flow of capital. Let's revisit Tesla's movement in early 2020. After a prolonged bottoming process, the stock suddenly broke through a long-term consolidation platform with huge volume. On that day, the trading volume was more than 5 times the average level of the past 3 months, accompanied by a sharp rise after breaking through a key resistance level without looking back. This was not a random fluctuation, but a clear declaration of a new trend's establishment. Similarly, in the Chinese A-shares market, a leading new energy stock formed a clear bullish alignment on the weekly chart under strong policy-driven forces, and the MACD indicator showed a secondary golden cross above the zero line, supported by continuously better-than-expected industry fundamentals. This formed a high-confidence trend initiation signal. Livermore referred to this as the establishment of the least resistance line. The initial forces are often the most pure and powerful after the market chooses a direction. However, too many traders either jump in too early, suffering unnecessary volatility, or hesitate when the breakthrough is confirmed due to fear, watching the opportunity slip away. Remember, trends are your friend, but you must learn to reach out when the trend is truly ready to walk with you. Identifying the trend is just the beginning. Pulling the trigger at the right key point is the core of the art. Livermore condensed his lifetime of experience into a simple yet incredibly powerful concept: only add to your position when the market proves you right. This is not a vague feeling but a precise interpretation of price action, volume, and market sentiment. The Bethlehem Steel battle was his masterpiece. After months of observation, he waited for the stock to break through a key resistance level with a massive surge in volume, clearly signaling that the buying power had completely overpowered the selling side. The moment of the breakout was when he issued the command to enter the position heavily. In modern terms, this evolved into a rigorous breakout trading system. When a stock breaks through a long-term consolidation range, such as a 20-week high, with strong fundamental support, accompanied by a favorable market environment, for example, the sector ETF moving in sync, and the breakout is followed by a pullback that confirms the support, this is the high probability, modern key point. However, the harsh reality is that ordinary retail investors are often disturbed by intraday noise, getting hurt in false breakouts, or missing opportunities due to fear of heights during genuine breakouts. The only way to overcome this is to establish clear rules. Your key point must be defined by objective price action, volume indicators, and market structure, rather than subjective speculation or emotional drive. In Jesse Livermore's classic trading rules, waiting for the price to reach the key point is a very important principle. In modern markets, this strategy is still effective, but we need to continuously verify these key points with technical analysis. How do you define a key point? A key point is not just about price breaking through a certain level or moving average, it's the intersection of market sentiment and trading volume. Only at such key price points will our trading signals be the most reliable. For example, when the price breaks through previous highs, if it is accompanied by large transactions and strong market sentiment, this is the time to enter, not blindly chasing the price up. Here's a real example. In 2020, after the US stock market experienced a sharp plunge due to the pandemic, the market showed strong signals of a rebound. Many investors still felt uncertain about the market in mid-March, missing the initial signs of the market's recovery. In fact, as early as late February, when the market bottom was already showing, some smart money began to position themselves ahead of time, and they were not disturbed by short-term fluctuations. This is the advantage of the key point trading method. It teaches you to enter the market in the most confident manner, rather than being swayed by market noise and short-term volatility. Even if you capture the key point of the trend accurately, 90% of investors will still be shaken out midway through the trend. The core failure point lies in the fragility of the position strategy. Livermore's pyramid position adding method is the essence of his position management art. The initial position is only a test, and only after the trend proves correct do you add in phases as the price pulls back to a key support level. Each addition improves the average cost and strengthens the safety cushion. Imagine you establish an initial position in a leading cloud computing stock when it breaks through a key resistance level, taking 30% of the total planned position. Later, the price pulls back to the breakout point and stabilizes, allowing you to add 20%. When the stock continues to rise, breaking through secondary resistance, with healthy volume expansion and ongoing industry growth, you add another 20%. The final 30% is only invested during the most powerful phase of the primary uptrend. This structure ensures that your large position is always established at a market-validated advantageous position rather than over-leveraging in uncertain trends. At the same time, dynamically protecting your profits is crucial. Once the price moves away from your cost zone, you must raise your stop loss to break even to ensure the trade will never lose. As the trend develops, move your stop loss below the most recent key support level, such as the 20-day moving average or a significant swing low, locking in most of the profits while giving the trend sufficient breathing room. Many traders tighten their stops too early after a small profit, getting shaken out by normal fluctuations, or they hold on during a profit drawdown with hope, only to end up with nothing. Remember, letting your stop loss automatically move up with your floating profit is the golden rule to protect your gains from being taken away by the market. In the long journey of holding positions, the biggest enemy is not the market, but the fear and greed roaring inside you. Livermore understood this well. Wall Street has never changed, and human nature has never changed. During the global market crash in 2022, how many people cut their losses in panic at the absolute lows and then missed the epic rebound? How many others were consumed by greed during the bubble frenzy in 2021 and ended up stuck at the peak? Modern neuroscience reveals the truth. When faced with floating profits, the brain's loss aversion area becomes exceptionally active, driving you to lock in profits as soon as there's a slight pullback, while in the case of floating losses, the hope bias distorts judgment, making you keep adjusting stop-loss levels while waiting for a miracle. The solution lies in forging your trading plan into armor against emotions. Before entering a position, write down in black and white your entry logic, target price, stop-loss levels, position, adding plan, and dynamic take-profit strategy. When market fluctuations attempt to shake you, return to this plan and execute it like a machine. A deeper level of practice is cognitive restructuring, understanding that market fluctuations are an inevitable cost, not a personal failure. When a normal pullback triggers your stop-loss, it's not a mistake, but a necessary wear and tear of the system, like a merchant paying rent. The truly fatal mistake is deviating from the plan and letting emotions take the wheel. Cultivating the ability to execute without emotion requires deliberate practice. After each trade, review your psychological fluctuations and the quality of your decisions. Over time, you will gain Livermore-like calmness in the eye of the storm. True trading masters never stop at the outcome of a single battle. They build survival systems that can withstand the test of time. Behind Livermore's legendary rise and fall is a profound respect for the essence of risk. The practices of modern top hedge funds quantify this philosophy. The risk exposure of a single trade should never exceed 1–2% of total capital. This is your safety margin that allows you to survive consecutive failures without damaging your core. Portfolio construction emphasizes the art of non-correlation, simultaneously holding tech growth stocks, consumer defensive stocks, gold ETFs, and treasury futures to ensure that there's always an asset that can hedge risk under different market conditions. But this is just the beginning. Imagine a scenario. You've heavily invested in an AI chip stock based on a breakout signal with an initial stop-loss set at -7%. 3 weeks later, the stock price skyrockets 30% due to positive industry news, and your risk exposure now exceeds your initial plan. The wise response is to take partial profits when the gain exceeds 15%, raise the stop-loss on the remaining position above the break-even point, and reinvest the released capital into new opportunities. This dynamic rebalancing ensures that your risk is always controllable and capital is never dormant. Remember, it's not a single mistake that destroys an account, but the lack of a systematic mechanism for stop-loss and regeneration after the mistake. View your trading as an organic life form that requires strict boundaries, risk control, diverse survival skills, diversification, and metabolism, capital rotation, to navigate through bull and bear markets. As we transcend a century in time, infusing Livermore's wisdom into the fabric of the modern market, a clear answer finally emerges. The fundamental reason for being thrown off the trend midway is the systematic break between cognition and execution. Recognizing the direction is just the starting point. The real holy grail lies in transforming cognition into a closed-loop ability to generate consistent profits. This requires you to operate like a precise instrument, intervene at key points, follow trends with a pyramid structure, protect profits with a moving fortress, tame your emotions with iron discipline, and ultimately achieve capital compounding through a rigorous risk system. Livermore had already discerned the essence. Money is made by sitting, not by frequent trading. Those seemingly dramatic short-term fluctuations are merely noise. What truly changes wealth levels is the ability to capture and firmly hold on to those rare, powerful major trends. From this moment on, Engrave this key position strategy into your trading DNA. Only act at the key points where trends are confirmed. Only add positions when you've been proven right. Always let your stop-loss protect your principal and profits. Use your trading plan to counteract human weaknesses. And finally, let a strict risk control system become your ultimate armor to navigate the market storms. If you found this content helpful, please don't forget to subscribe to our channel and feel free to share your thoughts in the comments. By understanding these investment philosophies, you've taken the first step toward the road to successful investing. However, theoretical understanding does not immediately translate into substantial returns in the stock market. Applying these strategies in actual trading requires long-term learning and practice. It's recommended that you start with small amounts, strictly implement capital management and risk control, and gradually improve your trading skills. Only through continuous practice and reflection can you truly master how to remain undefeated in the stock market. I hope that with every trade you make, you will keep these principles in mind, constantly refine your strategy, and achieve long-term stable profits. The next time you face a thriving trend, ask yourself, is my position strategy a carefully designed wealth engine or a fragile device destined to stall midway? The market is never short of opportunities. It only rewards those who truly understand and tame the power of trends. Start your engine and let profits surge. Don't forget to subscribe to our channel